Inflation in May rose higher than expected earlier this morning, with housing being a driving force behind the rise in the consumer price index. The inflation numbers also broke a 4-month string of easing price pressures and could force the Bank of Canada back to the drawing board regarding rate cuts. To talk about all of this, we have Beata Caranci. She's chief economist at TD Bank, and she joins me now. Beata, thank you very much for joining us. The big question that Canadians want to grapple with and want perhaps an answer to is, does this make it less likely that the Bank of Canada will reduce its key lending rate on July the 24th, the next time it's scheduled to make a policy announcement?
Yeah, it sure does. I think even the markets recognize that. We had seen markets priced over 60% odds of a cut in July. And following this report, that dropped to about 40%. So within our forecast, we had assumed that the central bank would not go at every meeting and that the July would be a skip. And that looks more likely, not because we're saying we're concerned about what we saw today. It's just they're going to need a bit more consistency in this data. And this one certainly was against the grain on expectations. So they'll have an opportunity to see two more reports if they wait until the September meeting and gain that confidence.
Is this a setback to getting to 2.0%, or is this to be expected that inflation is not going to move down consistently?
It's not going to be a straight line, and I think we've heard Tiff Macklin refer to this as well. But I think we've become so accustomed that or hoping that things just all move in one directionally. And as inflation is typical, it's a couple steps forward and one step back. And the U.S. is definitely experiencing this. We had a good run, as you mentioned, for 4 months. So this is our step back. And that's just going to put a lot more pressure on the next two reports to keep that step forward coming through in the data. I would say the one thing I'm a little bit concerned when I looked at this data is, where we're seeing price pressures remain strong, remain on the service side of the economy. We have seen that households are more willing to spend on services than they are on goods. And so that seems to be the area where we're getting a little bit of lift coming through on this report. So examples would be on personal care and recreation, as well as shelter, which we know is not going to be receding anytime soon. So that's where you want to keep your eye on, not necessarily everything in the economy, but maybe just what's happening in services.
And why is that a concern for you? It sounds like you think that could be a stubborn source of inflation.
Yeah, well, we know for sure that shelter is not going to recede, and that's because we have structural problems here in Canada, and the rental component in particular is, basically has shown very little movement in over 2 years. It's holding strong. And so we're not expecting that to be the catalyst for improvement on inflation. But we were expecting things like recreation prices and holidays and other factors to be a bit more disciplined in the pricing, and that did not come through in today's data. So that definitely was showing much larger increases than expected. And I think the challenge there is when you look at what influences service prices, it tends to be the pass-through of wages into prices, more so than when you look at goods prices, which are more tradable and can be influenced more directly by what's happening on the international front and supply chains and other factors. So when you see prices backing up on the service side, it becomes a little bit more of a concern. It's more influenced by domestic forces, and therefore it could be a signal that either there's too much domestic demand still on that front, or you're getting wage push pass-through coming through in the service side. So that's where they're going to put a little bit more emphasis going forward. And
remind us what we've seen recently in terms of wage growth in Canada. We're seeing it at well above the pace of inflation, correct?
Yeah, it's running, well, wages often do run above inflation. So you want it to usually run about 1 percentage point above. So if you're aiming for inflation of around 2%, typically you want wages to be at about 3% so that you have a real income gain going forward. But what we're seeing is a little bit more than that. And so the real income gains happen to be a bit more than expected. And so it's possible that we're getting some wage push pass through coming through on the prices. But again, I wouldn't want to read too much into 1 month's data. Like you said, we had 4 good months. We had a bad month. And we'll see what the next two bring us. But that's I think because we're seeing it on that service side, and we do know it has a high correlation to wage pressures, that's where our eyes are going to be firmly focused.
The Bank of Canada said some time ago that its forecast is that Canada will get to 2.0% annual inflation sometime in mid-2025. Is that TD Bank's expectation as well? And how many rate cuts does TD see during 2024?
Yeah, so that looks reasonable. We do need the shelter component to come down even on base year effects as we go forward. And because of that, we only have 2 cuts priced in for this year. It will be dependent on how the data evolves, but 2 more for this year. And then we hope they can get into a better pattern of cuts next year, meaning every meeting or every other meeting on a continual basis, and that the data is more cooperative. In order for that to be the case, however, you do need to maintain some degree of slack in the economy, meaning typically you maintain slack in the job market. So we still think the unemployment rate has more pressure on the upside as we go forward. We don't think the rise in the unemployment rate that we've seen so far is the end of the road. We think we could be up at about 6.7 or higher in the unemployment rate. It's already risen over a percentage point in the past year, but that's largely coming off of a labor force that's running ahead of what employers can absorb. As we get to the end of this year, we think there'll probably be more job weakness coming through in the data. And so those are the conditions we're looking for to help them accelerate their rate cuts. If you don't see that, we could be in a very slow grind down on the rates.